Hello traders, Gary Wagner here. It is Monday morning just before 11 o'clock in Honolulu, 4 o'clock in New York on the 6th day of January 2014, and this is the daily report for gold and silver. Definitely coming off of their highs for the day. We do have the metals basically unchanged. Gold currently trading at $1236.90. Puts it off roughly 50 to 75 cents on the day. The low, $1232.80. The high, $1249.50. Silver currently showing $2113. That puts it in unchanged territory. It has had a low of $1988 and a high of $2046 on the day. Traders, we did put out a buy recommendation yesterday to get long gold and silver. We put stops $1227 in gold, $1950 in silver. As I said, Kitco showing the low at 32. When we look at this particular chart, this is a half a day chart, and they are in Japanese average format, the Henkin Ashi charts. And you can see that we've had this long progression on this half a day all the way up. We did hit this high. This high came in roughly at 49. And you see this print down here. Now, when we look at this print, for example, on a 60-minute chart, you'll see why it definitely appears to be a misprint. Let's go ahead and bring that down. And this is our hourly chart, standard candlestick format. You can see this print in here as it comes down to about 12, but you can see that it's completely and utterly out of the entire range of the trading day. So we don't really look at it as a real print. As I said, market currently trading at around 1238, 1237, 1239. Now, in terms of our stop placement itself, we placed our stop below 1227, and my rationale or my thinking behind that was this. We are lining it up with this 23% retracement. And if this market genuinely wants to take off, as it certainly appears as though it does, it should be able to make it through. We put this order in just as it was breaking through this particular resistance line, and that's what led me to believe that we'd probably see higher pricing. Of course, since then it's backed off. We're sitting right now $12.39, so a couple of dollars from where we're in at. But my sense is that if it is going to continue higher, we should really not go, we should get these series of higher lows. We should not really go into the territory of these formal candles if we're on a true run in the market, and that will be determined as, of course, the market unfolds this week. Next chart I want to look at is our daily chart. This is a daily chart, continuous contract of COMEX Gold, and you can also see here that we've gone pretty solidly green over the last 3 trading days on a daily chart. Now, we are looking at a short-term 240-minute chart. There's this one print again coming down to about 1215. But the one thing, disregardless of this one print, as we look at it, we are getting body sizes, at least this last one that's just starting to form. We'll have to see how it unfolds. But we are getting smaller and smaller body size. My only real concern is in terms of potential resistance, and that resistance that we've talked about is up at around, call it 1244, 1245. Really like to see it be able to take this particular set of highs out. When we look at the market, we then would have another set of highs that are at around 1255. So in terms of looking at different levels of resistance, this is what I see. Our basic current resistance, shortest term resistance, is sitting at around 1244. That's this 23% retracement. Of course, it's the longer of the 2 retracements that we're working with. Then on top of that is going to be 53. Should the market be able to kind of hedge over these tops, you would have your next real level of resistance roughly at, call it 1273, and then again at 1280. So those are the levels of resistance should this market continue to move higher. Which really brings us to the most important question that we need to ask ourselves in terms of our current Elliott wave count, and that is we're looking at 2 distinctly different models. One model, this is our long 3, our 4th, currently in our 5th. One model would look for this market to continue lowers and to actually break the low that we achieved on the bottom of 3, which of course is 1181. The other model that we're looking at is a bear market truncation, in which this fifth wave would truncate. We've only had really a serious count of 1, 2, I see this as 3, and it would truncate at a third count. We would have a bottom that is basically a double bottom in here, and the market would move off from there. Because of the way the market has been reacting over these last couple of days, the beginning of this year, I should say, it really went counter trend. And my sense is that if they are going to rally this market, there is a significant opportunity to see this market move as high as some of the areas that we pointed out, roughly 1275, 1280. And that would be a significant move before we saw any kind of small correction. The fact that we are under a little bit of pressure, it has come off of those highs, has a little concern. We have a stop in place, but my real question is, what will we see if in fact this market does truncate and we have the market take off? Really, we needed to get back into the 40s. That's the 40s is where we actually issued the trigger, and it was because it was over a level of resistance right here that we found to be pretty important. But as it stands right now, we are at the beginning of a real rally in the market. Market has come off of a low of 1186, and as I said, we'll see how the market unfolds as the market begins to trade this week. And then lastly, silver. We're in roughly at this area. I believe it was 2019 was the area when we put out the recommendation. Weekly chart, obviously in Japanese average, it's starting to show us some potential. When we look at the daily chart, of course, let's go ahead and move that down. You can see that it has moved off of this quite nicely. We are showing support at 1958. Our stop, therefore, is just below 1950. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.